Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. This video is about a common question I'm asked. How much tax will I owe when I sell my home? This is a great question, but a loaded question. Like many questions, involves lots of variables, and it's so important that you speak to your CPA about your particular situation. With that said, let's jump into what those variables are. The first variable is this your primary home or is it an investment property? You see, the tax laws are very favorable when it's your primary home. Investment properties, on the other hand, are treated differently. The reason for this is the IRS does not want to create a tax burden for you when you're selling your primary home because they very well understand that you're going to need to move into another home. In comes the Section 121 exclusion. To qualify for this exclusion, you must meet the ownership test and the use test. You are eligible for this exclusion if you have owned and used the home for at least 2 of the last 5 aggregating tax years. Generally, you're not eligible for this exclusion if you've used it within the last 2 years. Okay, so let's jump into a few examples to see if these taxpayers meet the ownership and use test. Meet Susan. She bought her amazing home in January 2007 and sold it 10 years later. She lived in the home the entire time, but she was ready to downsize and go to a smaller place. Susan meets the ownership and the use test because she's owned the home for 10 years and lived in it for 10 years. But let's talk about Karen. Karen bought her home in January 2020, and by the following year, she was tired of it. She was ready to sell it, and she did. In fact, the only reason she bought the home was because she was pressured by her family to do so. Karen doesn't qualify for the exclusion at all in any test. In the ownership test, she only owned it for a year, and in the use test, she only used it for a year. So she won't qualify for the exclusion. Now let's talk about John. John bought his home in January 2001, and he lived in it for 3 years. He then decided he was going to move up north and rent out the home. And he then sold it 10 years later. While John meets the ownership test of having owned the home for at least 2 of the last 5 years, he doesn't meet the use test because he hasn't lived in the home for at least 2 of the last 5 years. So he doesn't qualify for the exclusion. So let's go back to Susan, since she's the only person that we talked about that qualifies for the exclusion. What exactly is the exclusion? Susan can exclude up to $250,000 as a single individual or $500,000 as a married filing jointly individual on the net gain of her sale. For example, if she was a single and sold her home for $350,000 after purchasing it 10 years ago for $150,000, she would have a net gain of $200,000. Because her net gain is below the $250,000 exclusion, it is 0% taxed. She will pay no tax on her $200,000 gain. As you can see, there's a lot of if, ands, or buts when it comes to the primary sale exclusion Section 121, but it is so lucrative. So if you do qualify for it, it's worth learning about. At Accounting to Scale, we love helping clients navigate technical tax exclusions like this one. Hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.